All right, Christopher, I think we're at the 2-minute warning here. You ready to rock and roll?
Yes, sir. Sounds good. We're recording.
Oh, we're on the clock. I'll be doggone. All right, well, good thing I went away and got my makeup on because I'm on video. So, I want to thank everyone for joining us this evening. I know that everyone may have some heightened emotions at this point. I'm sure that probably 99% of you now are in a state where you're on forced lockdown or in self-quarantining or, or just spending some quality time with your significant other at this point. So whether we like it or not. So we took this opportunity. We wanted to throw it out there as a chance for us to get together and kind of just talk through a few things with our clients, our friends, our associates, a few areas of administrative items, and then our feelings kind of, administrative items meaning staffing, what we have done, what we intend to do. We also want to talk to you a little bit about, some safety concerns you may have about your money, where it is, those of you who have us managing your funds. We want to talk a little bit about the market, what happened, where we think things might go from here. Some rule changes, which I'm sure are important to everyone. Tax filing deadlines, RMDs, that sort of thing. And then just some general thoughts after that. We'll take some questions and answers, a little Q&A at the end. Christopher, can you unmute yourself and give the folks instructions on asking questions, how we want to do that?
Yep. So once again, if you guys see, I see a few folks were able to send a couple messages. So there's a little chat box at the bottom of our screen next to the share button. If you want to send in a question for us, if you could please, at the bottom where you type the message, it says to everyone. If you could please change it to Chris Sadowski. If you click on the everyone, it will show my name. Just send them in there. I'll be sorting out the questions and we'll save them for the end of the call today.
I promise we'll try and get to as many as we can. Okay. Okay, so for those of you who do not know me, don't recognize my face, I am Chris Shipsky, one of the co-founders here of Athlon Advisors. And thank you for joining us this evening for our first official town hall. I think it's our first official town hall. So welcome. I'd like to be able to do this under some better circumstances, but I think I am very comfortable with the resilience of the American people, of our markets. And so I'm an eternal optimist. So I believe that we will all get through this. It's just a matter of time. So in the meantime, what is our response? What information can we give you guys today to help sort of alleviate some of your concerns and just have a general kind of conversation about what's going on and where we expect things to go. So our first point of order here is I'd like to bring our Director of Operations on, Dawn Sadowski. Dawn, are you unmuted at this point?
I am. I'm right here. Hello, everyone.
All right.
So I'm going to talk about office staffing and hours and what our plans are here. So we've been continuing to do our part to help slow the spread of virus, and we've been closing our office to foot traffic. However, this week we had a meeting, and we decided that starting next Monday the 6th, we'll be working from home. Up until this point, we gave everyone the option, either work from home if they were not comfortable coming in or come into the office. But after the governor's stay home policy, we decided we should have everyone stay home. So starting next week on Monday, we will still answer the phones Monday through Friday, 9 to 5 daily. We're still checking emails, messages. I would say if you call and we don't answer, please leave a message or email us. We will definitely get back to you. I mean, I'm sure you can imagine with everything going on, the phone lines and the email volume has been very high. So we are working incredibly hard to keep up. We do have to prioritize our responses, but we aim to respond to everyone as quickly as possible. So please be assured that we will get back to you. Client meetings. We're going to continue doing client meetings. We have been doing them. We, of course, have to use technology now, though. So we've been using the phones, and many people have Zoom meetings, which I think is working out pretty well. So we'll continue to do meetings. Paperwork. So we really want to make this easy for you, as easy as possible. We have several ways to do paperwork. We have, on the wealth side, we have the secure email. So we have technology to send you stuff securely, and you can send back to us. We've been doing DocuSign for email, electronic signatures. That's been working well. We also have a wealth portal that we can set up for our clients, and you could put your paperwork in there. That's working. And then fax, that's another way. And then if you're a tax client, they have Secure Drawer. They have their own portal. So that's been working well. You can upload, download, get your documents in their portal as well. We are encouraging everyone to use technology during these times, if at all possible. It'll be the quickest way. We will go to the post office, pick up our mail, but unfortunately, mailing back and forth is going to be a little bit slower because we are trying to do our part and stay home. And I think that's it.
Good. Good job, Dawn. Yeah, I mean, I guess in short or in summary, we're going to try and keep things as close to normal as possible. Yes, Dawn mentioned client meetings. If you would like to have a one-on-one, whoever your advisor is here at Athlon, please continue to call in, schedule all meetings through Pam. But absolutely, we're still taking meetings. You just won't get to see my lovely face in person, but you'll still be able to see it on the screen here. And/or Mike, Jim Siegel, Chris Shipsky, Colt Miles, Chris Sadowski, we're all still taking regular meetings. So please feel free to call in, schedule with any one of us. We will still take meetings. Paperwork delivery, yeah, if you have a specific issue, I would ask you to call in and find out the best way of delivering that information to us. But like Dawn mentioned, there's various different options for you, electronically and non-electronically. We do have options there as well. So we encourage everybody to go electronically so that there's no passing of paper or physical interaction. But if we have to do it that way, we do have procedures set up that way too. So nice job there, Dawn. We are going to full telecommuting for the office here next week, starting next week. We're going to take that week by week basis. Up until this point, the governor has not stopped us from coming into the office, although we've taken a lot of steps to make sure we stop the foot traffic coming in here. We've had a couple of deep cleanings from our cleaning company come in here. And we actually have done self-cleanings as well. As you'll see, I have a spray for my hands, and I use it pretty regularly throughout the day. So we have several procedures here in the office today. So next week, telecommuting, but really, again, nothing really changes from there except for the background that you'll see if you're talking to me. You'll be able to see the back of my home instead of my home office instead of my office here. So. Okay, so any questions about that, please remember, send your questions to Christopher via the chat room. We'll get them answered for you. I will say this, we will circle back and try and answer as many and all questions as we can. As we get into some of the more detailed information here, some of the information is just coming out. This is a very fluid situation, and we're getting as much information as we can, as quickly as we can, and we'll try, like I said, we'll try to answer all the questions to the nth degree that we can, but some things are just coming in so quick and changing so quickly, we may need to get back to you on some of the questions and answers. So we'll try our best, folks. We'll definitely try our best. Okay, next up, Mike, can you please address, in general, the safety of our clients' money, where it resides, separation of kind of duties and houses, and some insurance that's around those funds just in case. Oh, Mike, are you still on mute? Oh, Mike, you are still on mute.
Give me 1
Okay.
second.
There he is.
There we go. Look at that technology. All right. Welcome, everybody. If you don't know me, some of you do, obviously. I am Chris Shipsky's business partner and co-founder and co-owner of Athlon also. So, of course, at times like these, I feel it's very, very important that we all have comfort food, and I just want you to know that I have my comfort food right here. As you can see, I have Oreos and chocolate chip cookies, and that is the American way. So I've got my comfort food. So what I want to talk about a little bit is the safety of your money. I know when you work with us, there are a number of organizations that you come across which in dealing with your money. And I just want to talk about those organizations, how they function a little bit, and how it impacts the safety of your money. The safety of money, and when I talked about safety of money, it's not necessarily related to whether you are winning or losing in the stock market or the bond market, or you're actually making money or losing money, but actually, the fact that, if an organization goes bankrupt or something like that, what would happen to your money, So one of the things I first want to talk about is obviously the broker-dealer we're affiliated with is a company called Cambridge Investment Research. You see that name all over the place on our business cards, our stationery, on your statements, things like that. So Cambridge is a independent broker-dealer headquartered in Fairfield, Iowa, a little corn town in the middle of Iowa. But let's talk about Cambridge. Cambridge is a very financially strong organization. They have absolutely no debt. They have a very, very strong client and rep commitment, and it's one of the reasons why we are affiliated with them. They have been very forward-thinking in this whole crisis. Fully prepared. I just learned yesterday that 900 employees in their home office, 96% of them as of today are working remotely, and their operations are 100% fully up and operational and staffed and doing what they need to do. So they are a financially strong company. No need to worry about them. You also may be involved in what are called clearinghouses. So the two major clearinghouses that we use. Now, a clearinghouse in our business is a company that is sanctioned by federal regulatory authorities to handle money and securities, or custody money and securities. We at Athlon are not allowed to do that, and Cambridge does not do that. So these are repositories that actually take in money and securities and guarantee them. So there's two primary ones that we work with. Your accounts may be with one or the other. The first is Pershing. Pershing is an organization that's based out of Jersey City, New Jersey. It is a subsidiary of a huge bank called BNY Mellon. And so talking about bank a little bit, they're financially strong. And of course, their strength is very much heavily dependent on the strength of BNY Mellon Bank. So in 2008, 2009, we had a banking crisis in this country and an economic crisis. One of the things that came out of that crisis was the Federal Reserve Bank and numerous other federal regulatory authorities dramatically tightened up the rules on banking and mandated the banks be financially considerably stronger than they were then. So all the banks in this country, all the major banks in this country are very financially strong and are in much, much better shape than they were in 2008, 2009, when everybody worried about bank failures. So in terms of Pershing is being a subsidiary of BNY Mellon is fine. The other company is called FCCS, Fidelity Clearing and Custodian Services. It is a subsidiary of the big giant Fidelity Mutual Fund Company. Again, Fidelity, the mutual fund company, money management company, is a very financially strong company. The nature of its business, it is solvent. It is not, it has insignificant amounts of debt. And so money custody with them is also very safe. Talk about insurance companies. If you protect, we have maybe an annuity, insurance policies, things like that. What most people don't realize in the insurance industry is the insurance industry is covered by what's called the legal reserve system. The legal reserve system is an industry-wide sort of program fund in which all insurance companies participate. So for example, most insurance companies, you very rarely hear about an insurance company failing, but insurance companies have failed in the past and they will fail in the future. But one thing about insurance companies, when they fail, the legal reserve system steps in. What it does is it guarantees the policy owners, whether they be life insurance, disability income insurance, long-term care insurance, annuities, things like that, guarantees those the client accounts, and they typically take and transfer those accounts to a solvent or another insurance company who keeps the products in place with the exact same benefits you had with the previous company, and you'll just have a new servicing company and probably a new name on the top of the letterhead in the paperwork you get from them. So the legal reserve system, no one in the history of this country has ever lost money from the failure of an insurance company as a result of that legal reserve system. So your annuities, things like that, things that go out way far in time where the insurance company is promising you a sum of money either now or at some point in the future is also very safe. The investment industry itself is covered by what's known as SIPC insurance, that's Security Investors Protection Corporation. It is an insurance fund, and what it does is it protects investment accounts against failure of brokers, broker-dealers, investment houses, things like that. Every licensed investment operation in this country has to be a member of this insurance fund, and all your investment accounts are insured up to a maximum of $10 million. So if you have more than that, believe it or not, we can arrange more insurance for you. But so accounts are insured to up to $10 million against the failure of, say, Cambridge, the failure of Athlon, the failure of any organization, investment organization in which you have money placed. In terms of Athlon itself, we meet regularly, Chris and I and our staff, stuff like that. We are financially strong, we are solvent, we are profitable, and since we do not custody money or securities, we do not keep those things in our office, there's no concern with those things being lost or stolen or in any way, shape, as your money is compromised. So we feel pretty confident that from the standpoint of the safety of your money, that you're fine in this crisis, and there's no reason to believe that that will change. And you combine that with the fact that what's going on at the federal and state level, all the programs that they're implementing, emergency programs are implementing to get the economy back on track, solve the COVID-19 crisis and things like that, that your money is safe and secure, and there's no need to worry from that standpoint. So that's all I've got to say on that subject. So I think we want to move on at this point in time, and Chris and I are going to talk a little bit about sort of what happened, what's going on in the world, from our perspective, what we see. So I'll let Chris start that conversation.
Awesome. Thanks, Mike. Yeah, and feel free to, you know me, I got the gift of gab, so just cut me off and interject wherever you feel. So,
these short people talk way too much.
That's right. So obviously, unless you've been under a rock or off the grid, as some of us say, yeah, obviously you've heard of the coronavirus or COVID-19 at this point, and you realize that we are in the throes of a global pandemic at this point. I have a timeline I can certainly share with you, kind of where this all started and sort of our progression up until really just a day or so ago. But some of us may not realize this goes way back to 2019. Feels like way back at this point, but back in some say early as November for China, but the official timeline started on December 31st, 19, where China reported its first real case. So the first U.S. case was reported here on January 20th of this year. So as we started to hear more and more about all of this, get more information, as more and more information has come out, obviously that started to affect our markets. Here in the U.S., our markets hit a high on February 19th of 2020. If you think back then, it almost seems like decades ago. That wasn't all that long ago. At that point, fear started to set in to the market, and that's when we started to see some real repercussions, and the market started to head its downward slide. We really kind of started that on February 24th and we really had some very volatile markets. I'm going to kind of feed back in on what we did in response, what we did as a firm, but also what the Fed, the U.S. Fed here did in response. But if you kind of look at the market, it really started to slide there, like I mentioned on the 24th, some really big days down, not a lot of big days up, but there were some days in between that did bounce around and bring us back up again. We hit our low here in the market on March 23rd of this year. Since that time frame, March 23rd, the market has bounced back a little bit, and right now it's sort of hovering around about 2,500 on the S&P, around 21,000 on the Dow. Just to put things in perspective, during that time frame, this is the fastest bear market that we have ever recorded in history here in the U.S. It's taken 21 days to go from our peak to our lowest point in the market, that again is the official points. That's the fastest on record for us. Just to put it in perspective, those a bull to bear market usually takes an average of 177 days. So although we had plans in place, and we executed them to the best of our abilities. I've had private conversations with a lot of you regarding your accounts and your funds. Some, depending on kind of the type of management program that you're in here with us, some are more active, some are less active, but we have really had those conversations with our clients when times were good, when we can assess the risk then, so that we weren't doing anything in a panic. But I'll say it in the best way that I can. I'll use a kind of a weird reference from Mike Tyson, if you will. Everyone has a really good plan until they get punched in the face. Really what we saw, a peak to bear a market trial in 21 days, that's a punch in the face. But like I said, we did react accordingly. We did make moves in your accounts. And so I can't on this forum get into that number specifically regarding your accounts, and I don't think anybody wants me to do that. But bringing it around from the market to really kind of where the stimulus started happening, I do want to make a reference to something that happened early on when the market started to see their slide. So if you go all the way back to October 31st of last year, the Fed funds rate was right around 2%. And the Fed actually lowered its interest rate by a quarter point back then to make it around 1.75%. They did that because of, slowing global growth and what they call muted inflation. As we started to head into some of these more volatile times, we started to see Fed response, and in a number of different ways. The first thing that we actually saw was the Fed lowered interest rates again back on March 3rd. They did a 50 basis point or a half a percentage point lowering from 50 basis points down to at that point down to 1.25%. Then we saw phase one of the stimulus. I'll get more into that in a little bit, but we saw phase one of the stimulus come out. That was the Coronavirus Preparedness and Response Supplemental Appropriations Act. I love the way they name these things. Soon thereafter, again, the Fed lowered interest rates on March 15th, and they lowered them 100 basis points or 1 full percentage point to go all the way down to about 25 basis points or 0.25% or effectively zero. They also injected money into the banking system, and they basically said that the Fed said we are going to be the lender of last resort. They did that to stabilize the fixed income market. And the reason why I bring that up is it has had an effect on a lot of our holdings for our clients that would normally be deemed a little bit more of a conservative type of investment. Preferred stocks, fixed income, bonds, those sort of things really had some wild price fluctuations early on in this, market free fall. And that was purely due to the fact that it's hard to price something when the time frame is undetermined. And so when everyone said, well, we're going to close the doors, we're going to force companies to sort of slow down their production, we're not going to allow people to go out and spend as they did before, we're going to sort of force this slowdown. And you know, and they did that, and they said we're going to do this for an undetermined amount of time. When you leave it so open-ended like that, with no line in the sand, it's very hard to use fundamental type of valuation methodologies. So normally companies and the market is priced in using dividend discount models, earnings projections and reports. How can you project the company's earnings when you don't know when they're going to be coming back into business? And so you saw this sort of free fall early on in the market, and that also created some instability in the fixed income market, which again placed some undue price pressure, price fluctuations, which were very temporary and will still be temporary in our eyes. But they had these price fluctuations that you normally wouldn't see in some of these fixed income instruments. For instance, I'll give you an example, and this kind of gets into our conversation about why we think it's overblown. Is normally bonds, and I'm not trying to get too geeky on everybody here because I know it's an open forum, but normally bonds and how risky a bond is priced on a sort of premium over top of U.S. Treasuries. U.S. Treasuries are typically deemed a safe haven for investments. You know, risk-free assets are U.S. Treasuries. So if you invest in a bond, any other bond, a corporate bond, muni bond, high yield bond, it usually is expressed in terms of basis points or interest rates iterations above the Treasury. So that tells you how risky that bond is. High yield bonds were probably at the top, most riskiest type of bonds. Normally they trade at around 400 to 500 basis points above the U.S. Treasury, which is about 4 to 5% higher than a U.S. Treasury does, right? Well, when all this price fluctuation started happening and the market started kind of going to free fall and the pricing fluctuation started to happen, the high yield bonds rose up to a premium of 900 to 1,000 basis points. That's 9% basically over the premium of the U.S. Treasuries. That's unheard of, or I won't say it's unprecedented because it has happened before, but only once or twice in the last couple decades has that ever happened. So that kind of gets into our feeling about where we feel the market went, what happened, all this sort of, and where we think we're going. Mike, I'm just going to keep yakking unless you cut me off.
All right, I'll cut you off then. No, I don't want to. Everything that Chris has said is exactly right, and I think I don't want to get too much into the weeds unless you want to ask a question that gets us into the weeds. Stuff like that is obviously, you know, what you're seeing here is sort of an unprecedented event, and it really was sort of a healthcare crisis that morphed into an economic or spilled over into become an economic crisis. We've not had anything like that in modern times in this country to deal with. Every other, probably for everybody who's listening to us or watching us and stuff like that in their lifetime, we've had numerous economic crises, but we haven't had one that really began as a healthcare crisis. We've had crises related to war, we've had crises related to assassinations, to terrorist activity, stuff like that, but we've never really had a healthcare crisis to begin or spill over and become an economic crisis. And to reiterate something that Chris talked about is early on in this crisis, when it began to spill into an economic crisis, obviously stock markets, financial markets react to economic news. And they're very, very sensitive to economic news. And they react faster than before we even get the news. So stuff like that. So what you see is a result of sort of, because we've gone to computerized trading, there's algorithms, social media, rapid communications worldwide, things like that. Market reactions tend to be faster and bigger, and the numbers look, bigger all the time, whether up or down. And that tends to scare everybody. Okay, us included, believe me, when the market goes down 2,100 points on the Dow in a day, that's sort of scary. So a lot of it is this quick, fast trading routine that we now live in. About 80% of all trading on the New York Stock Exchange is done electronically via computer programming. And that has its advantages, and it also has its disadvantages. And we're seeing one of the disadvantages when things like this happen. So early on in the crisis, you have a lot of panic selling. the panic selling then triggers computer programs, which then automatically sell some more. And as the market falls and hits key points in value, computer programs kick in again, and more selling is done. So you get this sort of rolling stone, snowball gathering momentum going down the hill kind of environment. And that is what typically is happening, and that's why the numbers are so big these days. And it's unnerving. It's unnerving for us. It's unnerving for you as a client. It's unnerving for your accounts, and you're seeing what's happening. But the silver lining to that typically is when the markets rebound, the same thing kind of happens. So that, as Chris was saying, the typical bear market lasts this long and the bull market lasts this long. Well, those time frames are now compressed a bit more, and the numbers are bigger and the action is faster. So in a little bit later on in the presentation, I'm going to talk a little bit about what I think is going to happen in the future based on sort of 40 years experience in this business. But just want to reiterate that some of the things Chris said in terms of why this happened and why it was so fast and furious. So I think really what we want to do now is move on to, Chris is going to talk a little bit about an area that he's a lot more expertise about than I am, since he is a CPA, is some of the rule changes out there that are related to your accounts, tax filing, minimum distributions, all that kind of stuff. It is sort of confusing. We are a little bit confused by it sometimes. Some of the rules have already been are pretty definitive. We know what they are, and we'll pass that information along to you. Some of the rules are evolving, as in most legislation or anything that comes out of Washington. Typically when it originates in a politician's office somewhere, they come up with a great idea or a not so great idea. They pass legislation, but they don't really get involved in the details. They pass the details along to the Department of Labor, the Justice Department, the IRS, all the other regulatory bodies out there, all the other departments in the federal government, and then they pass it along to the states to do their thing. So of course it's up to all those different entities then to get into the weeds to determine the exact details of a lot of these changes in law. So some of these details we know of, some are evolving, some we don't have answers for yet, and the answers will probably start showing up over the course of the next couple of weeks or couple of months. We will, of course, keep you abreast of them as much as we can, and you can always feel free to call us and ask us questions. One of the things I think we pride ourselves on, if we don't know the answer, we will find out for you. So I'm going to turn it over to Chris to talk about some of these changes in sort of more legal accounting kind of procedures.
Awesome. Thank you, Mike. Yeah, I promise we'll swing back around too on where we feel things are going and why. But yeah, let me get to some of the meat of some of the what sort of has come out as a I'll say a byproduct of some of the stimulus that was enacted. So I'm actually going to rewind all the way back to January 1 of this year, prior to any stimulus, wherever that came out, because I don't know if I've had a chance to talk to everyone out there. Prior to the stimulus packages that came out, there was some new legislation that came out back in January 1. It was called the Secure Act. And the Secure Act was setting every community up for Retirement Enhancement Act. Again, love the names. This was a pre-stimulus, a pre-coronavirus type of act that came out, but it's important, and it does relate to some of the things that we have going on here that also then came out subsequently. So what came out of the Secure Act, only a couple of big items. Number one is your RMD, your required minimum distribution age, has now been increased. So if you were not taking required minimum distributions yet, as everyone knows from an IRA or deferred account, you have to take your required minimum distribution. Your first one is due April of the year. Following the year, you turn 70 and a half. That was the old rule. The new rule says now that date is at your age 72. So no longer do you have to take that required minimum distribution for the first time at 70 and a half. It is now 72 is the new date for the required minimum distributions. I'll have more on that in a little bit, but that came out from the Secure Act early in January. The second thing that came out from the Secure Act back in January is that they eliminated the maximum age for making contributions into an IRA. There used to be a maximum age, same as the required minimum distribution, at 70 and a half. You could no longer make a contribution into an IRA anymore. That age is gone. You can actually make a contribution into an IRA till you're 100 if you want. You do have to have earned income in the year in order to make the IRA contribution, but there's no more age limitation on it, which is a good thing. The last thing that came out from the Secure Act that's important to all of us is there's no more what they call stretch IRAs afforded to non-spousal beneficiaries of an IRA or deferred account. Used to be where if you were a son, daughter, niece, nephew, unrelated, and you received an IRA account as an inheritor, you could actually take it as an inherited IRA and stretch that out for your lifetime, only taking required minimum distributions out of it. That is no longer an option anymore. Because the Secure Act changed that, any non-spousal, so spouses are not included in this, non-spousal inheritor now does not have the option to take an inherited stretched IRA. They now have to drain the money in that deferred account or IRA within 10 years. There's no minimum they have to take out every year for the 10 years. Just by the end of those 10 years, that account has to be drained to zero. So that requires a little bit of planning for those inheritors who might be in a little bit higher of an income tax bracket already. So if that affects any of you or affects any of your siblings or anything like that, please have them give us a call. So 3 main things came out of that Secure Act before any sort of stimulus came into play. That was in January 1 of 2020, that was enacted. The first phase of stimulus came in on March 6th, 2020. That was phase 1. That was the Coronavirus Preparedness and Response Supplemental Appropriations Act. It basically gave money to Public Health and Social Services Emergency Fund. It gave money to the CDC, more money to the CDC, and it gave $20 million to the SBA for disaster loans. I'll come back to that in a bit when I talk about how that was enhanced in the CARES Act in a second. Phase 2 of this federal stimulus came out March 18th of 2020. That was the Families First Coronavirus Response Act. That expanded paid sick leave and paid FMLA, and it expanded tax credits for employers to help pay for that expanded leave. If you want to know the specifics on that, I'm not really going to go over it here. If you want specifics about that as an employer, please see us privately, send a question in. If you also want any information as how that affected you as an employee, please let us know. It did expand that area a little bit. What most people are focused on, what most people have been hearing about, is phase 3. Phase 3 was the big $2 trillion plan that came out. That was the CARES Act. That came out, was enacted on March 27th of 2020, and that was the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. Just prior to that, Maryland, the state of Maryland, for those of us who are in Maryland, and other states too, enacted their own relief for small businesses and individuals. So I'll go over a little bit of that for the state of Maryland, but if you're outside the state of Maryland, I know we have several of us on this Zoom meeting. I like the Brady Bunch effect looking picture too, by the way. I can see people's faces and everything. So I know we have people from all across the country on this. So if you have a state outside of Maryland, again, please send in the question specifically or see us kind of after this call. Make sure we get some info to you as well. So I'll go over some of the Maryland stimulus and mostly what came out of the CARES Act and some of those other acts. So what are some of the important things that kind of came out of all this? Number 1, tax filings and payment deadlines, right? The federal payment and filing deadline has now been extended to July 15th. Used to be April 15th, now it's July 15th. So you can file and pay all the way up until July 15th on the federal level, right? With no additional extension needed or anything like that. You just blow right through April 15th, wait till July 15th, and you can file and pay. That also applies to your first quarter estimated tax payment if you're making estimated tax payments. Your first quarter estimated tax payment, normally due April 15th, is now due July 15th. Okay? For those of us in the state of Maryland has coupled with the Fed. So they are on the exact same timeline for filing and payment and the first quarter payment for the state of Maryland. Other states have not. So if you live in a surrounding state, Virginia, Delaware, Pennsylvania, or another state, let me know, or please get in contact with me, because all the states are different. For instance, Virginia is not coupled with the Fed right now. They have different filing deadlines. So know what state, what your state deadlines are too. That may affect what we do in terms of filing extension for you or something like that. The next thing is RMDs, required minimum distributions. Remember how I talked about the age had been extended from the Secure Act? Well, we have more relief that came out in the stimulus package. RMDs have been suspended, required minimum distributions have been suspended for 2020. You do not have to take your required minimum distribution for 2020 based on 2019's data, based on 2019's balance, okay? And that is all required minimum distributions. Inherited accounts, you name it. It's all RMDs, right? A little bit of relief is here. If you've taken your RMD already and you're within 60 days, give us a call immediately because you can roll that required minimum distribution back into your IRA, right? If you're within 60 days and not have to pay taxes on that required minimum distribution, okay? See us. If you're outside the 60 days, see us too. There may be some other relief we have, but if you're within 60 days, because technically in the year 2020, there is no required minimum distribution. So therefore, what you took out was not a required minimum distribution. So therefore, it's eligible to be rolled back in. All right.
Chris, can I add something on this, Chris?
Yes, please.
Real quick, if you are taking RMDs, okay, and you have them in automatic mode, perhaps from an insurance company, annuity contract, mutual fund company, IRA account, something like that, and you've set it up for an automatic mode where it gets paid out to you, say, on November 1st every year, or something like that, and the company does the calculation and just sends you a check. Okay, so it's very, very important. The financial companies, for the most part, are not going to stop the automatic payment modes. It is up to us working with you, or you helping us identify accounts that you have with these companies that are in automatic mode, and we have to proactively go out to each individual company and stop that automatic mode. If you still want to take the RMDs because you want the money, you like the money, no big deal. But if you don't want the RMDs, we'll have to be proactive about stopping those automatic payments before year end. Otherwise, you're going to get it just like you've gotten it every year after. So if you don't need the RMD, you want to save some tax money, we need to be a little proactive and work with you and you with us in terms of identifying those companies that you're getting automatic payments from so we can stop them.
And Chris, can I bump in for one question too? With the IRA deadline being moved, the tax deadline being moved, does that also move the IRA contribution deadline?
Yes, Chris, it does.
Okay.
Thank you for asking that question. Yes, the deadline to contribute to an IRA is also moved to July 15th this year. So yes, you do have extended relief if you want to contribute to an IRA for this year as well. Normally, you can contribute in previous year to an IRA up until April 15th of the subsequent year. So we can contribute for 2019 if you haven't already. April 15th of 2020. Well, now that deadline has been extended along with the federal filing and payment deadline up until July 15th. So you have until July 15th to make an IRA contribution. Good question, Chris. Okay, I'm going to keep rolling.
That applies to all kinds of IRAs, Roth, traditional IRAs, SEP IRAs. It applies to all those kind of accounts.
Yeah.
Anything that you contribute to.
That's correct. SEP and Simple do have some different deadlines, but usually based on business income anyway. But you're right, Mike. It all from a traditional Roth standpoint, all that, yes, July. Yep. All right, let's move on. Direct payments to individuals. We've heard a lot about this, right? The government is going to send direct payments to individuals. $1,200 per individual eligible. $1,200 per individual. $2,400 for a couple filing a joint return, plus $500 for each qualifying child under 17. There's a lot of restrictions around these, right? So there is adjusted gross income limitations on these. So there's a lot of calculators that have been quickly built up on the web if you want to kind of see if you're eligible or how much you're probably eligible for. I'm not going to bore the crowd, but I can throw some numbers out there if you want me to, for adjusted gross income numbers of what you have to stay under in order to qualify for this. There's also a lot of, so please ask those questions to Chris. I'll certainly I'll spit those out to you. There's also a lot of questions about who can receive this check and who can't. There's also a lot of questions about, you know, are they going to use my 2018 return or my 2019 tax return? In general, if you file a tax return, you're eligible. If you have not filed a tax return, technically you're not eligible. It doesn't mean you're eligible, but doesn't mean you're going to get one. If you weren't required to file a tax return and you still have Social Security payments coming to you and or VA benefit payments coming to you, you're fine. You're going to automatically get the direct payments. If you don't have those forms of income and haven't filed a tax return, you may want to file a zero tax return anyway, just so that you make sure that you're on the Fed's radar for getting one of these stimulus checks. Most of us probably on this call won't have to necessarily worry about that. I think we've all filed or at least have Social Security, something like that. But if you don't, please come see us. It is what's called a recovery rebate check. So for those of us who are around after the Affordable Care Act, I think, came out, or maybe it was prior to that, we did get sort of, well, the Affordable Care Act had some recovery rebates in there as well based around health insurance. But think back even beyond that, before that, when we got, I forget, maybe it was George Bush, one of those, gave us a $600 check. And we had to sort of report that on our tax return the subsequent year. You are going to have to do that. It doesn't make it taxable. It's not included in taxable income. And if your 2020 income was higher or disqualified you for a portion of the rebate that you already got, you're not going to be forced to pay any of it back. Okay, but you will have to put it on your 2020 tax return. So just keep that in mind. Let me see what else. So lots of questions, I'm sure, about that. Please fire them away, and I will try and answer as much as I can. But like I said, this is a kind of a fluid thing going on here. So let's see what else I've got. Okay, unemployment benefits. They were expanded in a couple different ways. The amount was expanded, so now individuals can receive up to $600 more per week. And even self-employed individuals are eligible for this. So it seems kind of counterintuitive that a self-employed individual who doesn't technically pay in along the way into the unemployment insurance fund would be eligible, but they have expanded. And so now if you're self-employed, you are eligible for unemployment benefits. So it might be prudent for you to look into filing for unemployment benefits as well. Early withdrawals from retirement plans up to $100,000 are not subject to early withdrawal penalty up until 12/31/20. Now you have to prove that you were somehow affected by the coronavirus or COVID-19. The most direct effect, of course, would be if you yourself had it, if your spouse had it, but there's also legislation or code language in there that says even if you had experienced a financial hardship and needed the money because of that. So for those of us who needed to take money out of their retirement plans, IRA, things like that, and normally would be under the age, the 59.5 age, and would get hit with an early withdrawal penalty of 10%, that has been waived this year. So that's important for those of us who are trying to tax strategy that. Plus also, a really nice benefit that came out with that is if you take the money out now and you need it right now and you use it, you have up to 3 years to return that money to that account without being penalized. So take it if you need to, use it now, don't pay a penalty. If you never put it back, you never put it back. You'll pay tax on it, but you won't pay a penalty. But you have 3 years to get that back in that fund again, so that you don't end up paying tax on it either. Okay, it's like an extended 60-day rollover. It's extended for 3 years now. Okay. Hardship withdrawals from employer retirement plans. A lot of these, the regulations and the qualifying language around what qualifies as a hardship has been loosened and relaxed. So if you have a lot of money in your employer's retirement plan and you were thinking of tapping into that because you had to, a lot of those rules have been relaxed. Please talk to somebody before you do something like that. It does have tax effects, especially talk to us. talk to, whomever your tax advisor, one of us, please don't just take it out because Chris Shipsky told you to. Please, because there are tax effects, those sort of things. But it is afforded to you. Federal student loan payments have been suspended. If you're making student loan payments, they've been suspended through September 30th of 2020 with no accrual of interest. So basically, you can stop making payments, start them up again after September 30th, and no additional accrual of interest would happen. And for those of us who are business owners, there are two big loan provisions that have come out of all of this. One of them is called the Paycheck Protection Program, or PPP for short. What this does is it's a loan that is, now, which businesses apply? It's for small businesses. So these are businesses that have 500 employees or less. Okay, it does include sole proprietors and self-employed. So one of the programs is called the Paycheck Protection Program. It is a loan all the way up to $10 million. It's a loan that's based on 2.5 times your average monthly payroll that you've paid. So you have to have employees, you have to be paying payroll to them, or you yourself have to be self-employed paying compensation or payroll to yourself. And you take your average monthly payroll, 2.5 times that, that's your loan amount. Here's the beautiful thing about this. This is at an interest rate of 1%. Now, it used to be 0.5%. They just actually increased it to 1%, right? So if that loan never becomes forgivable to you, we'll get that in a second, you're going to pay an interest rate of 1% on that. 1% is pretty good, right? For those of us who need working capital, still not a bad gig, all right? But here's the beautiful thing about that. As long as you use it predominantly for payroll, you can use it for some other things, rent, utilities too, but only a small portion has to be used for that. But if you do use it predominantly for payroll to keep employees on your payroll and you keep them employed, or if you do have to let them go, you rehire an equivalent within a certain time frame. All right, so it's still an option. That loan can be completely forgiven. You may never have to pay any of it back. All right, so that is something that we all should look into for those of us who have employees. There's enough information out there. You have to go through a SBA lender. I would suggest a SBA preferred lender. Go out and Google that. You can find there's 1,800 of them here in the state of Maryland. So please, that's something that every one of us as business owners should at least go out there and explore. The other side from the federal government is what's called an EIDL, or an Economic Injury Disaster Loan. Okay? This is a low interest rate loan, 3.75%, but you can extend it up to 30 years. So you can basically treat it like a very low interest rate mortgage. The amounts can be up to $2 million. And again, the beautiful part about this one is if you pre-approve, you can get a $10,000 advance within days. So they're going to give you a $10,000 advance on your loan. You have money to kind of get you through the next pay cycle or whatever you need, or working capital to get you by. And then if you qualify for the loan, the additional funds will come in. So EIDL loans, Economic Injury Disaster Loans, through the Small Business Administration. Again, that's another area that each one of us should look at. Now, I mentioned that there are some Maryland relief out there, and each state has their own too. I'm going to quickly go through the Maryland ones. I'm going to give you the names of them, quick brief on them, and then I think I'm going to shut up and let someone else take the next section. So, all right, so some Maryland stimulus that's out there. Maryland has announced, Governor Hogan has announced the same thing. They encourage every small business in the state of Maryland to go out and explore these economic injury disaster loans. That's the EIDL. That's the federal one I just talked about. Okay? So Maryland came out with their own versions. They have a COVID-19 layoff aversion fund. It's designed to support businesses undergoing economic stress. The award is up to $50,000 per applicant. You have to demonstrate hardship or layoff aversion. Okay, it's a grant application. Right? So you don't have to pay it back. It's not a loan. Another piece of Maryland stimulus has been the Maryland Small Business COVID-19 Emergency Relief Loan Fund. That's a low interest rate loan. It's got a 36-month term. It's 2%. And if anybody wants these, I can give you a list. Just, contact us afterwards. I can certainly give you the list because they all sound kind of the same. There's a Maryland Small Business COVID-19 Emergency Relief Grant Fund. It's a grant of up to $10,000. You have to have 50 or fewer employees for this. And then last but not least, there's the Maryland COVID-19 Emergency Relief Manufacturing Fund. It's a $5 million loan incentive program for Maryland manufacturers who produce personal protective equipment that's urgently needed. So if you're in that sort of realm already, then you can get some relief there too. All right, I know there was a lot of changes. There's a lot of things out there. If you want more specifics or details, please contact us about any of this. I don't know all of the details about them. I haven't applied to all of them, but I can give you what I know. I can give you links. I can give you the information that I do know. So,
Chris, I have one more piece of information that got announced today in the state of Maryland. There are 70 banks that operate in the state of Maryland. The governor secured agreement from all 70 banks today that you can delay and not pay, make a mortgage payment for the next 90 days. Now, that does not forgive your mortgage payment. All it does is it adds 90 days onto the back end of your mortgage. But if you have a cash crunch going on as a result of this over the next 90 days, you do not have to make your next 3 mortgage payments. However, you can't just not make the payment. You do have to contact your bank or financial institution or whoever's holding your mortgage and tell them that you would like that forbearance. So that was just announced today by the governor.
Thank you, Mike. Appreciate it. Okay, so that sort of gets us circled back around to kind of where we feel things are going from here. What should you do, I guess, personally, right, for your family and your friends. So, Mike, I'm going to talk a little bit about kind of where we think the market is going, and then circle back on that, what we think you should do. So pipe in where you think, where you feel the market's going too. But we talked about kind of where what we thought happened to the market. Personally, here in the walls of Athlon, we felt that the market always kind of operates like a rubber band, right? It overextends on the upside, it overextends on the downside. My feeling, if I looked at the valuation numbers of the market after its major fall all the way down, I said the bottom was on March 23rd. If you look at that valuation gap there between the highest point and the lowest point, my feeling was that was an overreaction as well to the downside. At that point, if you took the valuation at that point, basically what they were baking in was a 60 to 80% drop in corporate earnings. That would indicate a negative earnings for corporations here in the U.S. all the way through 2020, but also through 2021. So again, I think that's an overreaction. I do not believe corporations will have negative earnings all the way through 2021. Another example of that was that high yield bond example I gave you. At that figure that I gave you, I said it was 900 basis points right now over top the Treasury, right? That valuation there, that extra premium that you would pay would indicate that at least 50% defaults would come in the high yield bond market. That would indicate that 50% of the firms that issued high yield bonds would go into default at that high premium, right? To give you some relevance and examples there, during the dot-com bubble burst back in 2000 to 2002, the defaults averaged at 9%. At the financial crisis, 2008, 2009, that figure rose to just north of 14%. MarketWatch just put an article out, I think it was days ago, that said that the S&P, the Standard & Poor's, expects the next 12-month default to go up to 10%. No one has said 50%. No one. So again, I personally feel that was an overreaction to the downside. The market very typically does this. It hits its bottom, it bounces up a little bit, it retests the bottom, and then it usually goes off in the rebound recovery mode from there. Personally, and I don't know, Mike will pipe in with his feelings, but personally, I feel that we've hit its bottom and we're in that retest area right now. So my feeling is coming down the road is we're just sort of waiting for the final retest and then we're waiting for the rebound. Remember, the market is a leading indicator. The market is trying to price in things 6 to 9 months down the road, not right now, not a week or two, not 2 months, 6 to 9 months in advance. So keep that in mind. Mike?
Sure. All right. So just sort of my thoughts, predicting anything in the future is sort of dangerous. And so as soon as I do this, I'm going to run and hide from you all. But so I look at this thing as in 3 components here. Is we've got sort of a healthcare crisis, we have an economic crisis, and we have a financial market crisis. So if I'm looking at the future, I'm looking at the future in 3 components here. So the first is sort of the future of the healthcare crisis. So that's the COVID-19 coronavirus kind of activity that's going on right now. So this is kind of the information that I've collected from some people I know. I have friends who work at NIH, National Institute of Health, and numerous other major medical organizations, research organizations like that. So what I'm hearing from the COVID-19 healthcare crisis future is that we probably have another 2 to 4 weeks of really bad numbers before this thing peaks in the United States. Okay, so and that means obviously what's going to happen, numbers are going to get big because more testing is going to go on. Numbers are going to get big because obviously more people are going to contract the virus and obviously more people are going to die from the virus. So it looks like we're going to have anywhere from 2 to 4 weeks of more bad news from a healthcare perspective. And that's disconcerting, but there does seem to be a sort of a glimmer, a little tiny bit of light at the end of the tunnel in these organizations as to what happens after that. Biggest fear after that is that we see the peak, the numbers begin to level off or go down, and whether the government does it or we do it personally, we begin to relax a little bit in terms of our quarantine, in terms of the kind of things we're doing, our social activity, all the stuff like that, and then we get a second wave. And that is a big concern with the healthcare organizations, that we would get a second wave. It takes approximately 2 months, according to the NIH, for the coronavirus to work itself completely through the population or the system before you get to the point where you can really say all clear. So the fear is obviously if this goes, say, another 3 weeks, it peaks, begins to level off and go down. We now have another 2 months beyond that before we can really say all clear. And the problem is in that 2-month time frame, we don't want another second wave. So that seems to be where the future of the COVID-19 thing is right now. And that's the best information I've begun to glean from some people I know. The second thing really is sort of the economic future of the country. Obviously, a healthcare crisis has morphed into an economic crisis. So obviously, you're seeing the news every night. Unemployment claims are skyrocketing. We've put in all kinds of stimulus packages, things like that. Companies are shutting down, laying off employees, et cetera, et cetera, et cetera. So the economy is tanking. We probably, when the numbers come out in terms of economic activity, we are in recession. We will probably have gone into recession in the first quarter of this year. We will definitely be in recession in the second quarter of this year. We may actually be in recession in the third quarter of this year. Okay, so that's just going to be bad news from employment, from economic activity, all those kind of things like that. However, alluding to some of the things Chris said, and what I feel personally is if we can get through the all clear on the healthcare crisis, my guess is most of corporate America will ramp up fairly quickly again. And that will, and hopefully at that same point in time, as we get the all clear in the United States, you'll see the all clear in several other places around the world, particularly Europe. We know in China, although the numbers are somewhat suspect, they seem to be on the downward side of the slope. So it looks like perhaps by year end this year, economic activity will be picking up. It may not be fully back, but it will be sort of approaching a little bit more normal, which should make for an interesting election this year. So economic activity, I suspect, is going to ramp up pretty quickly as companies try to get back online as quickly as possible once the all clear is given on the healthcare side of the crisis. So that leads to the third thing, is the financial markets. The financial markets, obvious, is what you are seeing in your statements. If you haven't gotten your quarterly statements yet, you're about to get them, and they are not going to be pretty. So the first thing I would tell you to do is either don't open the envelope, or open the envelope, look real quick, throw it underneath in the bottom of the pile, and ignore it, because you're not going to be happy with the numbers. So one of the things Chris alluded to, the financial markets are very much leading indicators. So as Chris said, and I've been in this business 40 years, so I saw the crisis in 81, 82, I saw the market crash in 87, I saw the crisis in 91, 92, I saw the dot-com bubble in 2000, 2001, obviously 2008, 9, so here we are again. So I've been through a number of these kind of things. So the markets tend to lead by anywhere from 6 to 18 months from a historical perspective. In other words, what the financial markets are doing is saying, listen, they're looking out 6 to 18 months, and they're saying, is 6 months going to be better than today? 12 months going to be better today? 18 months going to be better today? If the answer is no, the financial markets will either flatline or continue to go down. If the answer is yes, or even a qualified yes, with some degree of optimism, the financial markets will begin to pick up, okay? And things will turn around from a financial market perspective. The financial markets will always lead the economy, and that is important to remember. So, Chris alluded to the fact that he's an optimist, I'm an optimist. So I do believe 12 to 18 months from now, things will be better than they are now, which leads me to believe that the financial markets will be better also. And it leads me to believe that the turnaround in the financial markets is sooner rather than later. Now, most market crashes are followed by a sort of a period of consolidation at or near the bottom, which means up one day, down the next day, up one day, down the next day, and you get this sort of sideways movement. That's typically a result of a tug of war going on Wall Street and within major financial institutions and buyers and sellers as to what people believe, whether they're pessimists, whether they're optimists, whether they think the economy is getting better, whether they think it's getting worse, whether there's more bad news or less bad news coming down the pike, okay? So you have a little bit of a tug of war going on. I suspect that tug of war is going to go on for a couple more weeks. So I don't suspect any major move on the upside within the next couple of weeks, but I don't expect any major move on the downside in the next couple of weeks either. So you're just going to have, 500-point days up, 800-point days down, 900-point days up. You're going to have that kind of action, which means your accounts probably really aren't on a net effect going to go really anywhere. You're going to look good one day, you're going to look a little less good the next day. You just have to wait that out. But what I'm seeing, and when I talk to my friends on Wall Street and people I've known over the years, is that behind the scenes, the things that most of you do not see, because all you really tend to see is the Dow Jones numbers, the Standard & Poor's numbers, those kind of things, because that's reported in the mainstream press, is the behind the scenes, what's going on behind the scenes. So what I'm hearing now is savvy investors, okay, the Warren Buffetts of the world are now buying, okay? Bargain hunting is happening on Wall Street now. Prices have dropped by 25, 30%. I laugh with some of my clients, and you may recognize when I've said this to some of you before, it's like all of a sudden everything at Nordstrom just went 30% off. It's time to go shopping, okay? So savvy investors are buying, okay? Bargain hunters are now buying. Institutions are beginning to buy, okay? Pension funds are beginning to buy. That is a very good sign. These are people who stare at a computer screen all day long analyzing the market, trying to figure out how to make a buck, okay? And they get news faster than you get it, and they get news faster than I get it. So there are some underlying signs here that things are beginning to stabilize. So I do think that it's one of those times is, right now, basically, don't do anything, in terms of selling. If you haven't sold before and gotten out of the market, it's too late to do that. Don't do that now. It's a time to actually think logically about your money, not emotionally about your money. If you need help with that, you talk to us, that type of thing. Because I think what you'll see is probably within the next 2, 3, 4 months, the market will begin another upward trend. It will make up a good bit of the ground that we've lost in the last couple of weeks, and your accounts will look much, much, much better. The last thing I want to say is, you know, in an amazing kind of way, and it supports this sort of theory of mine, is that we have, you know, an unprecedented amount of resources being thrown at this crisis, from government at all levels, from industry at all levels, and from just citizens like you and me and everyone else out there. There is a sense that we are in a crisis and that we are all in this together. And, you know, this is probably the first time in history that there's this massive amount of resources from all major segments of the economy are being directed at this. So that will play out in a positive kind of way eventually. So I feel pretty optimistic about it. And if history is any guide, we will get through this. The markets will rebound. Your accounts will look better. And, you know, we'll all be happy this time next year, I hope. So that's really sort of all I have to say, other than, you know, don't look at your quarterly statements. Spend your time taking care of your family and friends. You know, from the healthcare standpoint at this point in time, do what you got to do to stay healthy, stay sane, and help those people around you. Thanks.
Cool. Thank you, Mike. Appreciate it. Thank you, everybody. But Chris, why don't we open it up now to some Q&A? I already got some sent to me, and if you want me to answer those first, I certainly can. But if you got some sent to you as well, I'd like to make sure we field those as well.
So we've been fielding some and trying to answer them a little behind the scenes for you. So the ones that you've gotten, why don't we let you start, and then I have a couple more for you here at the end.
Okay. One of the questions that I got, I already answered. It was about the extension of the tax deadline. Does that also extend the IRA contribution deadline? Yes, it does. So I'm not so sure who sent that question in. That was a question beforehand, but absolutely, it does extend it till July 15th. That's for IRA contributions. Another one was someone had mentioned that they already inherited an IRA account from a non-spousal individual, right? So they said, well, if I'm already in that situation where I've been taking the required minimum distribution, and maybe that's been several years or maybe just a year ago, or in that situation where they're already in that stretch IRA scenario, does that new rule that came out from the Secure Act, does that affect them going forward? No, you're grandfathered in. You can continue to do things like you were. This is for people who inherit non-spousal inheritors going forward. So those that inherited account after the effective date of the Secure Act, which was January 1, they're affected. If you've already inherited the account and you're in that inherited IRA, stretch IRA scenario, does not affect you. There was a subsequent question to that as well, that said they are taking distributions based on a deferred compensation plan, and are those distributions affected or suspended in accordance with the RMD rules? I will tell you, I don't know the exact answer to that. That's one of the ones I will have to go back and research. But here's my my initial take on that is the rule specifically talks about required minimum distributions from retirement type plans. Now, I know deferred compensation plans are sometimes rolled into that, but they do have specific contractual obligations attached to them. And so if that distribution is not technically deemed the required minimum distribution, I don't believe it applies. If it's in a required minimum distribution and specifically states that, then I think it would apply. But this is one of those questions. I'm going to have to get back to you on that one because I just don't know the answer there. My initial thought is that those are not suspended at this point. I would think you'd have to take them, but let me get back to you on that one. I had one more pre-sent question, and then Chris, I can hammer yours if you want. Someone had mentioned that in response to all of this, they changed their 401k allocations. They basically cut them down to zero and no longer contributing to their 401k. Was that a smart thing to do? And should they continue doing that? my response to that is, number one, you have to do what's going to make you sleep at night, first of all. So if that action let you sleep at night, as opposed to not letting you sleep at night, then of course, go with your heart, go with your gut. But what I would tell you is that the rules of dollar cost averaging and buying in low, I think Mike said it best. A lot of these things are on sale right now. You know, I was looking at my daughter asked me the other day is, can I buy stock in Coach and can I buy stock in Michael Kors? I told her, well, they're technically both owned by parent companies, so you can't technically buy Michael Kors or Coach, you know, per se, but you can buy stock in the parent companies. Those parent companies are what they call fallen angels right now, both of them. They both got beat up, and their bond ratings have gotten downgraded. So both of them have been really depressed. Like Mike said, things are on sale right now. So if you were thinking about buying Coach or Michael Kors or their parent company's equivalents at $38, and now it's down to $8, you're really buying it on sale. Just make sure the fundamentals are there, and we can help you with that. But now is not the best time to stop contributions in your 401k. Now, again, sleep at night factor first, but I would continue to contribute to your 401ks and your IRAs and your regular monthly distribution or contributions into your retirement plan and your brokerage accounts, because really you're just buying on the low at this point. Another thing I would say, a caveat to that is, if you need the cash flow because other cash flow has been affected, if your spouse doesn't, is no longer can't go to work or something like that, or your side gig, you can't go do the bartending thing you used to do on the weekends to make ends meet, and you need to cut contributions in your primary job or your 401k because you need the extra cash flow, well then of course that trumps everything too. But if you can still get away with contributing to your 401ks and IRAs, honestly, that's the best, because you're just buying on an average dollar cost averaging point at a low point. And like Mike said, I'm a little bit rosier than Mike Engler, actually. I think we're going to see a rebound in a shorter period of time. But even like he said, think out 6 months if you have to. Think out 9 months. Do you really think that we're going to be in this state 6 months from now, 9 months from now, 12 months from now? My answer to that is no. I think markets will recover, the economy will recover. That's just my opinion. So I think I've answered my pre-questions. Chris, what do you got for me?
Yeah, you had a lot of the same stuff. I have, like I said, we've been answering some stuff that we could here on our end. One of the questions was, did you have the name for the paycheck relief for employers again?
Yes, it's called the Paycheck Protection Program, or PPP. You have to go through the Small Business Administration, the SBA. There's 1,800 providers that do small business loans here in the state of Maryland. I would suggest Googling that to find a lender if you don't already have a lender. So I just got an email from wonderful Bank of America the other day. I have some of my accounts at Bank of America and some of them at BB&T. Also helpful, Bank of America sent me an email and said, you can only apply for the loan through us if you have an existing lending relationship with us. Thanks a lot, Bank of America. Way to be there when we need you most. So if you have a lending relationship with a bank and they're an SBA lender, then I would encourage you to go there. They basically have a lot of your information. If you don't, then you can go somewhere new. You just have to find one. I would Google, like I said, SBA lenders in your state, and I would actually look for a preferred SBA lender. That's even a step further. Those are ones I believe are going to be able to get through it quicker and be able to go through there. But it is a federal program that you have to go through the Small Business Administration on. So does that answer that question, Chris?
Yep, I think that answered what we got. Some of the other things that we have are just some more personal things that I have jotted down, and I've taken note of who said them, so we'll address those offline with folks. But at this point, I think that's about all the questions that we received. We were able to answer a lot of them.
Yeah. Chris, I may have missed one of the pre-questions that was sent to me. I do want to address it because I don't want anybody to think we forgot about them. Someone had sent in a question about our policy and implementation of stop loss process. For a lot of our clients, we do take a more active management approach. and you are in our managed accounts with stop loss activity on your account, basically the way that works is we have a sort of a preset level on each instrument that we invest, each investment that we go into. And when it drops to its stop loss level, we then step in and sell in the best manner that we can given the market scenario. So sometimes we'll step in manually and wait for a good selling point throughout the day. We drip out of the market that way, and we almost take the same stance on the way in. We're dripping out of the market when each individual position hits its stop level for us. So when it goes down to its stop level, then we sell. Sometimes we have standing stop orders out there on these instruments as well. But sometimes when you're in a market like we saw here in late February or early March, the prices are a little erratic. So we step in, strip off the automatic stop loss orders in there, and we sort of take a manual approach to it. But in theory, as the stops are, on each individual position are hitting its downside level, we sell out of the equity positions, go to cash, and then we reassess with our screens on the way in. And we actually have started to drip back in with some of our reassessment indicators. So in general, that's the way it works. I don't want to get too much into specifics because not everyone on this Zoom meeting might be in that program. And it would be hard for me to kind of address all the different positions to each individual. So I'm not even sure who sent that in. I got a blank page with it on there. So whoever actually sent that in, if you want more details of your current scenario or your current account, please give us a ring, set up a private one-on-one Zoom, and I can go over numbers exactly for you on exit and reentry. So.
All right, awesome. And then we got a couple more trickling in, but one question I saw here that might help some folks. If you're getting pushback on these small business loans, do you have any suggestions for folks in dealing with the banks at all?
One more time, Chris. You broke up there for a bit on me. What was that?
So somebody said they were getting, one of the people they knew was getting some pushback on applying for small business loans from their bank. And they were just wondering if you had any suggestions on how to deal with that with the banks.
Vote with your feet. Go elsewhere. Yeah. I mean, there's a lot of banks now that are going to be pushing you off because they don't want to deal with the volume, especially if the interest rate for them is only 0.5% or 1%. So yeah, I believe that you will see that pushback. That's not a lender you want to be associated with. Find another lender. There's plenty of them out there. I've got a bunch of emails actually from lenders ready, waiting to go. So I would find another lender. That's why I spoke so highly of Bank of America. That sort of thing makes me angry. In the time when we need them most, they're not there. That's, in my eyes, that's it's just not a way to do business. I don't want to be a part of something like that. So if anybody works for Bank of America, you feel like telling them, Chris Shipsky will no longer be a client soon after this crisis is over. It's just not, there are plenty of opportunities out there. And if they can't do it for us when it's lucrative for us, only when it's lucrative for them, I don't want to be a part of that. So yeah, I absolutely would expect that there's some banks out there that are going to have pushback. I would just find another one. Like I said, there's 1,800 here in the state of Maryland. I'm sure each state has their own long list. Just find another one. And I know it's a pain in the butt. However, those applications are federal applications. So if you've got a hard copy of it, if you've got, you only have to do the info gathering all at once, right? So you use that application to apply at one lender and you use it to go to another. So go through the lender that's going to help you the most, but it's a federal application.
All right. Thank you. Thank you for that insight. That was pretty much it on the questions. I know we're at about 6:30 here. So yeah. Did you see any more questions that you had to answer, or?
I'm looking through my chat window to make sure. Trying to see if there's anything I missed here. I got the inheritance.
No, I don't see anything on my end. So
yeah. I'm also gonna export all of these questions. So if we didn't get to you, today, we definitely know who asked those questions, and it may be a little bit more of a personal matter that we want to address offline with you. But absolutely, we appreciate all the questions that you guys are sending our way today.
Thanks, everybody. Really appreciate you showing up. And again, you know, there's a light at the end of the tunnel here. I believe we'll all be okay. Let's just, you know, be calm. If you can wait this out, we're going to wait this out. We will see a rebound in the market. Our economy will return. We're a very resilient bunch here in the U.S. So I believe, you know, in relatively short order, we're going to see some good times ahead. Let's take the opportunities as they present themselves.
And I'm happy to say that our first Athlon Town Hall, we had 59 participants. So thank you all for joining.
Wow. Yeah, thank you all, every one of you. We appreciate you.
Thank you.
Thank you, folks.
Stay safe and healthy.
Thank you.
Thank you, Chris, and everybody there for that information. Have a good night.
Thank you,
Thank
Fred.
you.
Bye.
Bye.
Thank
Thank you.
Thank you. Thank you.
Right.
Thank you, Mike.
Have a good weekend, everyone.
Thanks.
All right.
Night,
See you,
guys.
Chris.
Bye, Chris.
Bye.